But that's not how life insurance companies play with options. They look at options and they do it as a hedging strategy, which is to mitigate risk. And so I think a lot of people don't understand what options are, and they look at them as this way to get big returns in some way, shape, or form. But that's not the purpose of them, and that's not how life insurance companies use them. So I think it's important to understand that. And it's also important to understand the market environment that we're going into, and realizing that with the market environment that we're going into, it's going to have a negative impact on the cost of those options charges. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, we're going to be talking about infinite banking, index universal life, whole life insurance, but more importantly, can you do infinite banking with index universal life insurance? Now, I'm going to tell you the answer is no. You have people out there like Curtis Ray, like Doug Andrew, like a lot of these people on TikTok that are out there telling people infinite banking, infinite banking. There's so many videos right now on TikTok and on YouTube Shorts and Instagram doing these little 60-second clips on all the powers of life insurance and how Disney and Ray Kroc and J.C. Penney and the Rockefellers and all these people use cash value life insurance, and they implemented infinite banking, and you should go do it too. And here's this new great cash value life insurance, and it's index universal life. And the reality is those people didn't use index universal life. They used whole life insurance. Index universal life cannot be utilized for infinite banking. And here's why. Because infinite banking is not about a product. It's about a philosophy. It's about how we handle our money. The biggest misconception that people have about infinite banking is that it's just arbitrage. So let me break this down for you. So what I mean by that is basically saying arbitrage. I'm just going to write it. Arbitrage. All right, so arbitrage is saying, okay, if you put money, let's say 10,000 into a life insurance contract, and then you go and you want to be able to access, so that money is going to grow no matter what, so you can access your money, let's say 4%. And if you could earn 5.5% while you're paying 4%, that's 1.5% arbitrage. This is the arbitrage number, right? So the idea, the people who think that you can utilize infinite banking for with index universal life think that it's just about this arbitrage number. And the reality is nothing could be further from the truth. It is so much more than arbitrage, because at the end of the day, this arbitrage number in an IUL contract isn't even guaranteed, because the reality is you could be paying 4% and the market could have a negative year, right? You could have 0%, and so you're going to actually increase your costs. So therefore, it doesn't work with infinite banking. Whoa, we just lost that. But it doesn't work with infinite banking because of the fact that you can actually have a negative arbitrage number. Now, there are other areas that I think it's really important to understand. Infinite banking is not about just arbitrage. It's about control. It's about a philosophy. It's about building your finances on a foundation of rules and understanding. One of the biggest things I kind of tell people is that if you implement infinite banking properly in your life, it's basically a set of rules. It's a filter that you make all of your financial decisions through, right? It's the only financial strategy in the world that will guarantee that your quality of life, that your standard of living will get better and better and better on a guaranteed basis as you go through life, as long as you execute and implement accordingly, right? Like the only variable in you being successful and reaching your goals is your ability and willingness to execute and do what you need to do. Now, when we talk about infinite banking and we talk about IUL, what I'm going to spend the rest of this video doing is going through index universal life, talking about the control component of IUL. Once again, arbitrage, it doesn't work. That's not infinite banking. Inside of infinite banking, you need to have control of your money. You need to have the guarantees. You need to have no surrender charges. You need to have good early access to your money. You need to make sure that that money's going to grow on a guaranteed basis. And there's no way around it. Like if you don't have that, then it's just not going to work. And so there are components in every single IUL policy that are involved. I'm not even kidding. Every single IUL policy has these elements in it, at least in some way, shape, or form. And I'm going to break it down in real big detail for you in a couple seconds. But every single IUL has these elements in it. And inside of this, if you don't control these variables, then somebody else is controlling you. Somebody else is controlling your money. Somebody else is controlling your financial system. And my problem with Index Universal Life as a whole is the fact that people say, hey, like you want to avoid the 401ks, avoid doing all this stuff in qualified accounts and put it in an IUL because you don't want to be in business with the government. You don't want to trust the government. The government could tax that money away from you. But guess what? When you put your money in an IUL, it's the opposite. Instead of being in business with the government, you're in business with an insurance company. And at the end of the day, they control the results in your policy. And so what I have is I have a list of things inside of the IULs that I want to share with you and I want to show you that are the variable moving parts that when you understand this, that you will truly understand why you can't do infinite banking with Index Universal Life. So here we go. All right, so behind me here, you can see a list of 11 different areas that impact Index Universal Life performance. Now, once again, in order to do infinite banking, you need the guarantees, you need consistent growth, you need to know that your money is safe, liquid, accessible, controlled by you, not the insurance company, not anybody else. And so this is a list of 11 areas that I think are important for you to understand before you get into Index Universal Life, before you start putting your money into this, that you understand these are all the areas that get impacted by things. So now, options cost. Here's the deal. This is what's going on. So options cost in a volatile market, options costs go up. Right? So I'm just going to say this. So I just want to do this here. So in a volatile market, options costs increase, right? And so what happens is, listen, we're going into a whole set of unknowns in the economy right now, right? Like the interest rates are going up. Michael Burry right now is calling for a greater crash than 2008. There's a lot of things going on. Nobody knows. There's so much uncertainty right now. That volatility, if you understand how options work, then you understand that options are not designed to make a lot of money. Options are really designed to hedge bets, to hedge against risk. That's why if you look at the IUL illustrations, nobody talks about options costs. They talk about a hedging cost because what's going on here is it's a hedge. That's all options are. Are there people out there that will trade options and try to hit huge home runs and make big bets on big plays like Michael Burry made, I think it was like $900 million in 2008 betting on the crash when nobody else saw it coming? Yeah, sure, there are people that do that, that will do calls and put options, in the market based on whether they think it's going to go way up or way down, and they make these really exaggerated bets that are a bit asymmetric. But that's not how life insurance companies play with options. They look at options and they do it as a hedging strategy, which is to mitigate risk. And so I think a lot of people don't understand what options are, and they look at them as this way to get big returns in some way, shape, or form. But that's not the purpose of them, and that's not how life insurance companies use them. So I think it's important to understand that. And it's also important to understand the market environment that we're going into, and realizing that with the market environment that we're going into, it's going to have a negative impact on the cost of those options charges. Now, I'm looking at this and I'm realizing that I left one out when I wrote this out. I'm going to write the general fund performance. I don't think I have that on here anywhere, right? So I'm going to write general fund performance. All right, so, that's my bad handwriting for you. So that's a bonus one. So 1B here is general fund performance. And what happens is the general fund performance is caused by the fixed market, because what happens is you put your money into the life insurance contract. The life insurance company then says, okay, Chris has $10,000 in his IUL contract. We're going to take that $10,000. It's going to be in the general fund. We know the general fund, we're going to be able to get 4%. So that's 4% of $10,000 is $400. So they're going to say, hey, we got $400. That $400 is going to create an options budget. The options cost and the options budget, those combinations are what will drive the rest of everything. So these two things together, you need to understand that one foundational understanding just just at a very, very base level. If you understand that, then you realize all the rest of this stuff is a bit smoke and mirrors and is predicated based on the performance of the general fund and the options cost. Now, there are a lot of people, this is why I've been kind of saying people, I'll bet pretty much anybody that whole life outperforms IUL over the next decade, because listen, over the past decade, I have the IUL challenge where IUL didn't even perform when it's supposed to have upside potential and downside protection. It didn't even hit the projected rates in the greatest bull run that the S&P 500 has ever seen, right? Why? Because it doesn't matter what the S&P 500 performs at. What matters is all these variables that impact the actual performance of the policy, and they are driven at a foundational level from the general fund performance, which, yeah, it can increase the options budget, but then if the options costs go up because of volatility, that obviously negates the benefit of the budget. And that's why Bobby Samuelson says he thinks that cap rates and par rates and participation rates and spread charges, all these things are going to keep moving to the detriment of the policyholders. And so this is kind of 1 and 1A that I want to make sure you understand that going into it. Now, here are the other areas why you can't, and remember, I'm doing this all through the lens of why you can't utilize IUL for infinite banking, right? And so that is the first and foremost, because you never want to take a risk inside of the insurance policy, and anything that you don't control, you're going to ultimately be taking unnecessary risk, in my opinion. And so number 2, cap rates. Life insurance companies can drop cap rates. Typically right now, cap rates are anywhere from 8 to 10%, but they can be reduced to a 3% guarantee. So I can tell you back in 2011, when I was selling IUL, there were cap rates at 16%, and the cap rates on those products right now literally are under 7%. So we were illustrating them at 8.1 to be really conservative, right? Because a 16% cap rate, 8.1 really conservative. Now the cap rate is actually below the assumption, so those things are never gonna work. I had to do a lot of work when I transitioned away to have a lot of really tough conversations to save a lot of people. Par rates, sometimes they're fixed, sometimes they're not. Participation rate is basically saying if you have 10% return in the market with 100% par rate, that means you get 10%. If you have 140% par rate, that means you would get 14%, right? And depending on what the cap was. But it's basically you multiply whatever the return is by the participation rate. So if we had a 50% par rate, it would equal 5%, right? So that is how participation rates. A lot of times they're guaranteed. The par rates are guaranteed. A lot of times they're not. It depends on the type of index it is. But at the end of the day, cap rates and par rates are the most common. Now what happened was these were getting manipulated a lot, and they built a lot of bad pub. So companies went out and they created no cap rates, no cap indexes, I should say. So they would say, well, we got the S&P 500 with an 8% cap or 8.5% cap with a 100% participation rate. The 100% participation rate is guaranteed, but we could lower the cap rate. Instead of 8%, we have the contractual right to lower it to 3%. People look at that and they go, that doesn't sound good. But what they did instead is they created spread charges. So they created no cap. I'm going to just write this here, no cap indexes. And so in the no cap indexes, they either have one of two things. They have a par rate that can be manipulated, or they have spread charges, right? You have to look. Every company is different. You have to understand that these two things are always going to be involved here. So if it is a par rate in a no cap or in any product, they may be guaranteed, they may not. But spread charges in uncapped rate, let's say it's a 7% spread charge. I'm going to say spread charge. This means the first 7% of everything earned in that index is getting taken by the company. You only earn above and beyond whatever the spread charge is. So if you have an IUL and the spread charge is 7 and then the index does 15, that means you get 8. If it does 10, you get 3. If it does 12, you get 5, so on and so forth. Typically, here's what happens. The spread charge is typically not guaranteed either. The ones like that I looked at from Symetra, from Nationwide, typically those spread charges can get increased to 20%. Once again, These fees, these things in the policies can always be manipulated to the benefit of the insurance company, not you. And so I don't know about you, but let's say I'm putting my money in the S&P 500 and the company has the contractual right and ability to increase my spread charge potentially to 20%. That means the S&P has to do 20% before I get paid a percentage point at all, any kind of return? No, thank you, I'm good. I'm all set with that. Not to mention, if there's no spread charge, there's probably a participation rate that can be reduced to some really low number, like 30% or whatever. That means if the S&P did 20%, you'd only get 6% return. So it makes that uncapped index not really as appealing. Cost of insurance charges. And once again, every product, every company is going to design and structure these a little bit differently, and they're going to handle all these fees a little differently. Like, so cost of insurance. Cost of insurance charges are not guaranteed by every company. Now, here's the deal. The cost of insurance can be increased. There's a couple components to this. So the cost, they usually do it with cost of insurance per $1,000, right? So it's per $1,000 is how you pay for that cost of insurance. That's one way to look at it, but there's also a thing called net amount at risk. Net at risk. I do NAR for net amount at risk. And so when you look at net amount at risk, that is the spread that you have in an IUL policy. That is the cost of the insurance that you're paying, right? So like, for instance, if you have a $500,000 life insurance policy when you first start, what's going to happen is that's your net amount at risk is $500,000. If they do an option B increasing death benefit, what's going to happen is if you get $10,000 of cash value, your $500,000 death benefit is going to go to $510,000. So you're always going to have that $500,000 net amount at risk. Now, what's crazy is as you get into retirement, based on all these other charges, that net amount at risk can create a lot of risk for you, the policy holder, and that is a big problem. So understand, cost of insurance and net amount at risk are two things that, once again, you're typically not in control of. Admin charges are not guaranteed. Look through the fine line. This is why I'm saying, look through every illustration. You got to read every line to figure out where are they trying to get you in the policy? Where are they shifting the risk from them to you? Admin charges are not guaranteed. Load fees, they charge a lot of times when you put a lot of money into cash value, you'll get hit with a 7, 8, 9, 10% load fee. Once again, different for every company. You have to look that up. Market performance. Market performance is kind of a double-edged sword here, right? Because let's say you're doing the S&P 500, right? Okay, so S&P 500 goes out, and with the S&P 500, you get, let's say, the market does 10% one year, it does 15% the next year, it does negative 5% the next year, you know, all this stuff. Here's the bottom line, none of this matters, right? Why does none of this matter? Because the market performance, A, if interest rates are going down and there's a bunch of zeros and negatives, negative 5%, whatever, that means you're gonna get flat across the board. If it does well, guess what? We just had the greatest bull run of all time, and that's why I created the IUL challenge, is because nobody has been able to show me one policy that over the past decade in the greatest bull run that has outperformed what they illustrated when they sold the policy. That's a big problem. If they haven't been able to do it then, they'll never do it. And so when you look at this, as interest rates go up, right? As interest rates go up, what happens is typically asset prices come down. Assets are stocks. Stocks are the S&P. And so if we think that the market is going to do poorly here, market performance risk is a real thing inside of these IULs. And once again, you can't have that kind of risk inside of an infinite banking policy. It just doesn't work. It is the opposite of what you want to do. You want to utilize your infinite banking policy to borrow against and take risk in other assets. You never want to take risk inside of the life insurance policy. And by having a market performance risk in there, even though you're not directly in the market, you're leveraging the index, but it's actually worse that you're utilizing the index because the index can do well, but they can change the cap rates, par rates, spread charges, all these other fees, and it could still perform bad, right? So premium expense charges, these are monthly premium expense charges, typically annually, monthly, whatever. These are not guaranteed. These can be increased on you. I think it's really funny. I go through a lot of these fees And a lot of IUL agents come to me and go, well, Index Universal Life is so much more transparent than whole life because they actually show you what the charges are. They show you like line by line what all these charges are. And whole life, they don't show you the charges at all. I said, well, do you know why that is? Because when you look at a whole life policy, what you see is what you get. Everything is guaranteed, it's locked in stone, right? So when you look, it's very transparent from the context of like, when you look at it, here's what my guaranteed value is. Here's what the current assumption value is based on the dividend rate where you're participating in the success of the life insurance company, and the insurance company is taking on the risk, not you, the policyholder. And this is, this is what it looks like. This is what you're putting in every year from a premium deposit perspective. This is what your cash value is. There doesn't need to be a breakdown of all the other expenses and charges because what you see is what you get. With an IUL, they're not showing you all those fees and charges, all these things to be transparent with you. They're showing them with you because regulators tell them they have to, because they're all variable. And it's not for all the fees, it's for the little asterisk up in the top corner of the page that says these fees may change at any point in time, and if they do, it will have an impact on the policy, right? Now they say changes to these fees could be beneficial, more or less beneficial to policy performance, and I got news for you, it's always less beneficial. So that is something to consider. Monthly policy fees, same deal. Rider charges and multipliers, this is a big deal. Multipliers, this is an area where a lot of people like these. They illustrate really well. Pac Life came out with, was kind of like the company that led the charge with the multiplier thing, with the PDX product back in, I want to say like 2015, 16, 17, 18. They started really hammering out. After AG 49 came out, regulation AG 49 came out that kind of put a governor on what the illustration rates could look like. They created multipliers, which basically inject risk into the policy. And it injects risk into the policy to be able to show a higher illustrated performance. And at the end of the day, I can show you on an illustration. Just because I show you on an illustration doesn't mean it's actually going to be there, especially with IUL. The only guarantee with an IUL illustration is it's not going to perform the way that it's showing you. And so this is what I can tell you. Index Universal Life 100% of the time will look better on paper than whole life insurance. Because whole life insurance is a what you see is what you get product. It's not overly inflated. I don't believe you should buy any policy based on what the illustrated columns say. I think that's the truth for whole life. I think it's the truth for IUL. But I think with infinite banking, the real power in infinite banking isn't the policy, it's you. It's how you leverage it. It's how you use it. Now, the question there becomes is what do you want out of the policy? You want liquidity, use, and control. You want security. You want guarantees. You want to be able to access that money in case of opportunity. That's why I always say your infinite banking policy should really just be your emergency fund and your opportunity fund. That's what it should be. And if you position yourself, we know that the market is cyclical, right? We know that the market is going to go up and come down, up, down, up, down. And we know that it's going to trend up over the long run, right? So if we know that, it's these moments, right? It's this moment, this moment, this moment. It's on the down cycles. This is when the most millionaires are made, right? The problem is most people have bought into the idea that these are the times that we're trying to do and make the money. But the bottom line is it doesn't matter what you do here. It matters what you do here. It matters what you do here and here. And with Index Universal Life, they try to sell you on this indexing where like it goes up and then you have the floor. So when it drops off, you're going to keep growing from there. Right? And it doesn't. I'm telling you right now, because of all of these components, I get on paper it looks that way, but when you start adding in all the fees and you start looking at the fine print of the contracts, you realize that they don't actually perform that way. So, listen, I know that's a lot of information, but that is the number, I don't know, 12 reasons. Those are the reasons that you cannot utilize IUL for infinite banking. Now, I'm going to be real straight with you. I didn't do a lot of prep for this video. I'm just kind of doing this off the cuff because I had somebody bring this up to me and talk about, hey, I'm just going to do IUL for infinite banking. And I had to have kind of a walk them off the ledge kind of conversation because I knew how much money they were putting into their policy and how this would hurt their financial livelihood. And I had to connect them with somebody that I knew could help them make a better, more informed decision for their objectives, for how their financial structure needed to be built. I think at the end of the day, when you think about retirement planning, when you think about a 401k or saving for retirement or anything like that, and looking at income distribution in retirement, the other component to this is, if we just use a little bit of common sense, the focus of all this, I want to go back to general fund performance and options costs. The general fund performance for most life insurance companies is 4%. Options cost is going to be all over the map, but it's going up typically right now. So if the general fund of the life insurance company is getting 4% right now, that's what they're getting. And they're going to take your money that they know they can get returns with, and they're going to then go buy options with it to get you a return. And they can get you this, let's just call it 5.9% on a very predictable, guaranteed way, after the cost of insurance, after all these different things. If they could do that for you, if the insurance company could take this 4% and turn it into 5.9, 5.8 magically for you somehow, if they could do that, why are they not doing it for themselves? If they could do it for you after the cost of insurance, after all these things, why are they not doing it for their own general fund with no cost, no insurance, no anything? Because they have access to go do it. They have the money. They could go do it all day long. They don't do it because it doesn't work the way that you're being sold that it works. It's all a ploy. And one of the biggest rules of thumb to look for is, if you want to find why Index Universal Life is not going to perform the way that their current cap rates are, is go look at their correlated indexed annuity, and their cap rates are going to be much lower. Why? Because they actually have to guarantee those. With an IUL, they have all these ways to kind of manipulate the return of the policy to offset the risk from them to you, and that's really what it comes down to. So if you have any questions, comment in the comment section below. If you haven't already, make sure you subscribe, hit the bell, that way you're notified every time I launch a new video. I hope you found this valuable. Until next time, have a blessed, inspirational day. We'll talk soon. See ya.